Okay, if you're making power payments on your mortgage, if you're paying extra each month on your mortgage, you need to stop doing that. You need to stop doing it right now. I'm going to tell you why. I had a conversation with some friends of mine over the weekend, and they were saying that they were power paying their mortgage. I said, stop. I said, stop doing that right now. And they said, but we want to pay it off early. We're going to pay it off in 15 years. I said, I understand. I get the logic, but here's the deal. What you're doing when you power pay on a mortgage is you're giving the bank $1 today instead of giving them $1 30 years from now or 25 years from now, depending on how long you have left on your amortization schedule. And the problem with that is you're giving them $1 that has today's purchasing power instead of giving them $1 that has the purchasing power 25 or 30 years from now of a US dollar. The purchasing power 25, 30 years in the future of a US dollar is going to be dramatically lower than it is today, just as the purchasing power of a dollar today has dramatically less purchasing power than it did 25 or 30 years ago. And here's the big trick, okay? Here's the big concept. Anytime you borrow money at a rate that is lower than the rate of actual inflation, you should not pay off that debt early. So if you borrow money at 4% and the rate of actual inflation is, say, 7%, then the bank is actually losing money on the purchasing power of the dollars you're paying them over the life of the amortization schedule. So you borrow $500,000, whatever it is, and you're paying that back, and you start paying it back in today's dollars, but you finish paying it back in weaker and weaker and weaker and weaker dollars as time goes by. Whereas if you were to borrow money at, say, 7% and the actual rate of inflation was 4%, then you want to power pay your mortgage. In that situation, you're losing purchasing power because you're paying more in interest than they're losing in purchasing power. Whereas right now, the economy has changed. We have permanent low interest rates, or we at least have long-term low interest rate environment, and you've locked in a 30-year fixed loan. And what's going on is you're paying strong dollars today, and you're going to be paying increasingly weak dollars, and you want to keep paying increasingly weaker and weaker and weaker dollars to the bank, which is exactly what's going to happen over the life of a 30-year mortgage. So do that. Don't give them the stronger dollars now. Let them lose the purchasing power. Let them lose out, and don't feel bad for the bank, because the banks have every advantage in the world. They own your congressman. They own your senator, okay? They get bailed out when the economy turns down, and you don't. And also, they're leveraged 19 times over. So the reality is they borrowed that money from the Federal Reserve at like 1/2 of 1%, and then they loaned it to you at 4%. And they're making the 3.5% spread. They're not even loaning you their own money. They're loaning you new dollars that got created by the Federal Reserve. So don't feel like you're doing, an injustice to the bank or something like that. Stop power paying your mortgage and instead do one of two things. One is take those dollars and put them into your house. So put a new deck on, remodel the kitchen, do a new amazing shower in the master bathroom, whatever. Those things will actually add value to your house. You spend $5,000 on your master bathroom, and now your house is worth like $10,000 more. So you can double up immediately on your equity by spending that $5,000 and getting an immediate $10,000 return in terms of the equity in your house. Or even better, and here's where things really get exciting, take those dollars and instead of paying them to the bank, save them up in a savings account and then go buy another house using a 0% down, 1% down, 3% down, 3.5% down owner occupied mortgage. Just buy a second house and move into it. And now you will have purchased the cheapest thing that you can buy these days, which is money. Because in a low interest rate environment, the cheapest thing around is money. Stocks are expensive right now. Houses are expensive right now. Food is expensive right now. Gasoline is expensive right now. But what's cheap right now? Money. So buy the money and use it to take control of another investment, especially something that would cash flow. If you have a mortgage payment of $2,200 and you could rent that place out for $2,300, you're in a very solid position moving forward. You move into the new house, you rent out the old house, you're cash flow positive on that with your locked in 30-year rate, and now you've purchased the cheapest investment you can make, which is new US dollars, in order to take on a second amortization schedule in which the bank is going to lose a lot of purchasing power over time, which is fine because they're leveraged 19-1 with their bank ratios and they get the money from the Federal Reserve and all that junk. Okay. And you are now taking advantage of inflation by putting on your side, buying and locking in a cheap rate over a long period of time, and then paying back increasingly weaker and weaker dollars over the course of a 30-year amortization schedule. So you got to think like Wall Street. Okay. You got to think like a financier. And those are little tricks that, you got to read books and all that crap to do that. But I've done that for you. I read those books and I'm here to tell you about it. So love you guys. Hope you're doing great. Check you soon.